Hello and welcome. I'm Patrick Curtis, your host and chief monkey, and this is the Wall Street Oasis podcast. Join me as I talk to some of the community's most successful and inspirational members to gain valuable insight into different career paths and life in general. Let's get to it. In this episode, Douglas Rogers shares his long and winding path after graduating from Cornell in 1996. We learn about his stint as a broker-dealer, his time as an associate portfolio manager for ultra-high net worth individuals, as well as what happened when he founded his own advisory firm only a few years out of school. Listen to hear where there were pitfalls, the lessons he learned, and why, after several stints at senior positions at boutique IBs, he's decided to become CEO again with the launch of Semi-Cap Equity Partners. Enjoy. Douglas, thanks so much for joining the Wall Street Oasis podcast.
Thank you, Patrick. It's great to be here.
So it'd be awesome if you could give the listeners a short summary of your bio.
Absolutely. I'll try. I've certainly taken a differentiated path. So, I started out my career after a short break from college back in '96. I started out my career with Morgan Stanley Dean Witter in retail brokerage. I had really exceptional brokerage training. It was one of the best on the street at that time. But I really wasn't fit for just phone calls, which is really what the job was at that time. So I very rapidly transitioned into fee-based asset management with a small boutique asset manager based across the Bay of San Francisco, and really enjoyed the work. That really taught me, I think, really an exceptional grounding or exceptional skill sets in portfolio construction and research and securities analysis. We had a great client base, mostly high net worth individuals, some pension and plans, et cetera. And but that really also taught me the value of working closely and collaboratively with clients to achieve, certain financial objectives. And but there were some twists and turns with that company as well. When I first got there, my manager was, certainly getting up there in years and had some health issues, which I was going to find out, which were impacting the business, as everybody else in the office moved within a week of me starting and left me alone with a very old but fairly successful asset manager. And at the time, I didn't understand what the implications of that was, but I certainly do now. And so fast forward, I actually ended up running a vast majority of the portfolio, everything from research and trading to having meetings with the Schwab accounts that we were involved with, and meeting with Abby Joseph Cohen, the senior economist at Goldman Sachs at the time, and our prime broker, and all sorts of things. But I was also stuffing envelopes and doing billings and running around and answering phones. So it was really all encompassing. It was all encompassing business.
And so you would be called like an associate portfolio manager then, or that was like the title back then. And basically you're doing everything now.
Absolutely. Yeah. And that really taught me, I think, a very broad spectrum of skills, which was wonderful. But the health issues of the manager really were starting to impact the business. And at the time, this was in '96.
Were people taking their money out because it was known that there were health issues, or was it the performance of the?
It was that he couldn't remain focused, and he was starting to act very unprofessionally in the role, and that was impacting the clients more so than the actual performance. It was really the day-to-day workflow that was getting significantly impacted and eroded, and it was just the environment wasn't very healthy anymore, and he was absentee most of the time. And would show up, and I think a lot of people have had this type of management experience, manager experience, where he shows up from time to time in a huff and is really short of breath and short of mind space and very terse around everybody else, and then just storms out. And so nothing constructive actually gets done. Right. So it's really just they come in, they build a fire, and they leave, and you're left with the fire in the middle of the office, and you wonder why you're doing it. But at the time,
this is the late '90s, right?
Yeah, this was late '90s, and it was just at the time where fee-based asset management and wrap fees, right, 1%, 2% of assets under management, where that was exploding. So I had the brilliant idea, where I thought it was brilliant at the time. I had the brilliant idea that I could do this as an actual firm. I mean, I had set up all of our technology. I was running all the technology and the trading and the research, and I had maintaining all the prime brokerage relationships. So I thought, well, hell, I could actually make a business out of this and do this for others. All
Hmm.
the breakaway brokers that were coming off the street at that time and going into fee based, I thought this would be a brilliant business model. And so I actually lit out on my own impetuously, far too young, with no capital, and started my own thing. And I founded a company called Managed Source Financial Group, or at the time, Managed Source Research.
Okay.
And the original intent of Managed Source Research was to provide this kind of turnkey operational, business for breakaway brokers that were leaving the street and setting themselves up. And I could, obviously implement the entire operating and
How,
execution platform and strategy.
how is it structured, the business model? I'm curious. Did you charge them like a consulting fee? Was it like a retainer? How did you? I'm sure you went through many iterations, the business model and how you were doing that and the pricing and all that. But I'm just curious.
Never, never even got there, my friend. Never
Okay.
even got there. If you recall, one of my last sentiments was that I left with impetuously and too young with no capital.
Yeah.
So it was really demand pull. So actually, I printed up some business cards for myself, and I ran down to there was a money show I think a week later, which was, it might still be around, but one of those retail oriented financial conferences, and I ran down to a money show to drum up some initial interest. And I had matriculated into the CFA program at the time, and I had become a very strong writer because my educational background had very strong English departments, and
Hmm.
so I was a good writer and a good head for business. And the original demand pull was for equity research product. So actually, we never provided that turnkey solution, which we started out to provide, and we actually started writing research. So back in this is in late '98, going into 1999. The company was established and became an independent equity research and business valuation firm.
And just give give
And it
give the
actually,
listeners just to give the listeners a little more perspective. You graduated from Cornell with a BA in
yes,
history, so nothing about
yes.
finance, nothing. So, but a great, probably an incredible writer, like you said, because of that education. So, what prompted you to even go to Morgan Stanley to start out, and what prompted you? Like, was finance on the radar ever? Or like, how did you even end
Well,
up?
yeah, my official major was in history, but I was studying history and economics, and I was
Okay.
always very strong in math and economics. It was really easy for me, and I was always kind of enamored with the stock market, which coming out of the '80s, everybody was. Right? I was
Yeah.
born in the '70s, a product of the '80s. I mean, everybody wanted to be barbarians at the gate.
Right.
Um, so so I was always fascinated with that, and quite frankly, I actually was looking at initially. I was looking to try to get into management consulting or something along those lines, where I guess I perceived a lot of prestige and similar backgrounds to mine.
Hmm.
But a friend of mine, said he was working in brokerage, and he'd been very successful. He was a couple of years older than me, maybe a decade older than me,
Yeah.
and he said he could get me an interview. So that's really how it happened.
Got it.
And obviously, once you go through that sort of training and you get all of your securities licenses, then obviously it made sense to really just to try to stay close to that line of business, and so my career just progressed from there.
So you had,
But it was
had a
really about
you basically had a
broker.
year. Yeah, you basically had a year there where you're picking up the phone, dialing for
Yes,
dollars,
yes,
and then you jump to this kind of odd situation where you're with a older PM or whatever. You're running the entire business with, everyone leaves right when you arrive, and then you kind of jump out on your own. And so
yes,
it quickly pivots to an equity research shop. Am I following so far?
yes. That is correct.
Okay, so you're doing that, and then tell me how that evolves. So it starts with $0 of revenue in 98, 99.
Yes.
Who's your first customer? How does it grow? Is it rocky? Is it, you're off to the races? How does it work?
No, it was definitely rocky. Obviously, securities work or anything in this industry is always rocky,
Mm-hmm.
um, which is why it generally is a business of scale for sure,
Hmm.
to layer in the different revenue streams. But it was somewhat rocky. At the time, there was strong demand for corporate sponsored research, which is, the small public companies that really were orphaned from the street or just were seeking to get their message out or get more focus on them, would pay directly to research firms for equity research products. This was very common at the time. There were
That's not,
multiple
to me, that
providers.
seems like a very big conflict of interest, but okay, continue.
Well, of course,
Yeah.
we haven't gotten to the research settlement issues, which was kind of strange. But yes, there were a lot of conflicts in the industry. But at the time, right, that was that was a check,
Yeah.
and it got us started out.
You mind
And
sharing
it
like
got
what a check would look like? Is it like a $20,000 check for like a report, a $10,000 check, 5,000?
Yeah, there were usually about it was usually some sort of annual fee, so you
Got
could
it.
do your work consistently, and they would range from anywhere from $15,000 to $30,000 a year.
Okay. Got it.
Um, and also, and then alongside, we started to launch the fully kind of independent equity research product as well. So we were writing on both, and we would clearly delineate which was which, and we were producing both reports of our own construction and our own ideation, and working for clients. And it was that client side that actually got me back into, I think, a mindset that was similar to that kind of fee-based asset management, where I started working with the executives very, very closely, and they started to bring me into more expansive roles. For example, some of them would have me start drafting some of their securities filings for them, because they
Hmm.
realized that I had that kind of, that skill for writing in that particular style. I mean, when you read a securities filing, it's kind of a, if, when, might, should, would, could, will be the greatest thing, but maybe not,
Yeah.
sort of style, and it's very particular. And it just kind of rolled out of me. So I started getting closer to my corporate clients. I started writing and drafting some of their securities filings, 10Qs, 10Ks, S1s, things like that,
Hmm.
and found that I really had a knack for it. And that continued to progress through the years into business valuations, fairness opinions. These are all, fee-based projects, and
Yep.
fee-based kind of, research-centric products. And ultimately, it progressed later on. The final iteration of what we did at Managed Source was full CFO for hire services, and we
Mm.
were brought on typically by private companies that were in the pursuing a public listing of some sort, whether it be through merger or through direct registration.
Hmm.
And we would come on in a as a CFO for hire capacity, and I would handle everything from some of their accounting cleanup requirements, all the way through PCAOB audit, and then obviously constructing and writing the S1 filing,
And
incorporating the financials, et cetera.
when you
So
say was it
yeah.
you and a team, or was it mostly you doing the heavy lifting with like a support team around you? Or
It was at that point it was mostly me. We did grow to a point of about 10 or 12 employees in the middle section. So I kind of fast forwarded from late
Yep.
90s into the early
No, that's fine. So you're doing more
2010.
interim CFO services, and that, I mean, that
There,
lasted this for what, 14 years almost. This
yes, there was a big push. So there was a big section in there from 2000. I'm going to say 2002 to about 2007,
Mhm.
where the global research settlement, coming out of the dot-com era bust, or the dot-com bust, really opened up the opportunity for independent equity research providers. And
Mm.
that's where I saw the significant opportunity in the equity research product to take it fully independent, from the standpoint of, obviously, no upfront compensation of any kind.
Mhm.
And we started to integrate our product with, Reuters and Moltex and all of the independent providers. We considered ourselves up there with like a Soleil product at the time, and I anticipated XBRL coming down the pipe, and automation and automatic data delivery. So I developed a team in India to do a lot of our data mining and construction of our portfolio models, which we would use as the base layer for our financials. Then I had
Yep.
a CFA as a director of research come in and finalize the research, and we were able to very efficiently get a significant amount of research product out into the market. Hundreds of reports under coverage. vast majority in technology and healthcare, where
What were
obviously
the
there's always good
what were the
opportunity.
what were the unit economics on something like that who are running this type of
Uh,
business?
this is why we transitioned into the CFO services. The
Yeah.
economics were horrible. There
Yeah.
were no economics. What ended up happening, and we're serious, very seriously,
It's
we
fair.
invested very heavily. I raised some capital,
What did you
and
think? What did you think was going to happen? Like you were going to get these were going to be private reports that all these hedge funds would come pay you for to access for or something.
yeah, we had two models. First of all, there was the kind of direct subscription model, which there are still a few firms like a New Constructs, for example, a firm that I met back then, who have really stayed committed to it and built a good practice.
Right.
Shameless pitch. He's actually doing excellent work. New Constructs had some similar concepts about how to draw in automated data to simplify and streamline the production. But no, so we were looking at our own direct output of selling subscriptions to the research and selling the research directly through our website, and then selling it through our independent equity research partners, which included again Reuters, Moltex. I think one of the large. I don't want to misspeak. I think it was a Citigroup. I can't recall. We had a couple of large providers that we were starting to output our research to.
Yeah.
We then also started to contract with small broker dealers that didn't have research products. So we could outsource and black label the research for them or sell our research for soft dollar participation through their channels into the institutional realm.
Got it.
So all of these things were areas of opportunity for revenue generation, and we were kind of putting them all into play.
Got it. And so then what would you say is the peak, and then why did you in 2012 after a 14-year run, what kind of made you kind of have that transition to go in the investment banking side at another firm?
Well, because let's put it this way: we had
You said you had
maybe
12 at the peak or whatever, 12
yeah,
employees,
I
so a
mean we
couple
had
million of revenue or something.
that's really why we had a couple of let's just give one example: the Reuters Moltex. So Reuters um, uh, started to generate its own research product and then highlight its own research above all of the independents that we had brought in.
Ouch.
And of course, the institution started to realize the research and their analytics were proprietary. So everybody started to regenerate and redevelop their own proprietary research. And I remember getting one check from Reuters after we'd already had, I'd spent thousands on press releases about research coverage and, more thousands on people and production. And we had hundreds of reports on Reuters. And I remember getting a check for like $35. And that was it. And when I saw that check, I said, this industry is transitioning back to where it was. And at that same moment, I was starting to get requests just from my network for, hey, could you be our CFO? And the economics there were very strong.
Yeah.
And so it was very clear to see that this product set was going to have to either move in one or other of a different direction.
Was it tough
And
when you kind of made that realization? Was it like a tough transition for you? I can imagine like you've put so much blood, sweat, and tears in this thing for over a decade. And then to be
you
like,
know,
okay, now time to move on, or were you just nonchalant about it?
I'll tell you, that one was very easy. That was probably the easiest transition that I made in my career because I wasn't swimming upstream. I built notoriety for myself. There was
Hmm.
enough material out there that there was a decent brand at the time,
Hmm.
and people were starting to in-call and request that sort of that sort of committed role as a CFO for hire or something like that. So that was actually very easy because the economics were there, the demand was there, and
But you just scaled down the team, so it just really became you.
yes,
Basically, is
exactly.
that the idea? So instead of all these reports you're putting out and building up your name, it was more now, but you just kind of becoming a hired gun
Correct.
to go and do this. And was that what Merriman Capital was? Is that how I should think of that, or what was that the next
So
stage, or was that still at Managed Source?
the transition between those two was after the Great Recession.
Okay, right.
So what really happened, it was really funny, Patrick. The CFO services business was going exceptionally well. I
Hmm.
did start to see some of those same factors that had plagued research coming into the market, meaning there were a couple of very well capitalized, kind of larger CFO for hire types of businesses
Yeah.
coming into play, but we were so differentiated and focused on the securities work, and whereas the well-marketed CFO for hire was really a bookkeeping function, getting
Mm-hmm.
paid $100 an hour, and we were charging 10,000 a month minimum.
Mm-hmm.
So it was very differentiated product, but I was seeing some of that evolve. And so really what I wanted to do to progress with the business, and yes, I did pull it back to just me to incubate this and develop it. And it got to the point where I hit my limiter of about 4 or 5 separate clients at a single time,
Mm-hmm.
making making really good solid revenue.
Mm-hmm.
And so from that point, I wanted to push the business back to really core securities functionality. I saw the tremendous value in having proprietary funds, for example, that could take advantage of the companies that we were already working for. So, one small piece about managed sources, I maintained, or I registered us as a registered investment advisor to maintain basic levels of FINRA registration and compliance
Yep.
functionality, things like that. And so I really wanted to have the business move back to institutional securities work. And what that was going to look like was proprietary funds and assets under management to take advantage of the registered investment advisory side of the business. And the hope was that we could have some basically merchant banking capability that could serve the corporate clients on the CFO services side.
So you're saying almost as
that was
if,
the intent.
so as you were getting brought in for these corporate clients, mostly private companies, to either prep them for an IPO, for going public or whatnot, right, you also wanted to have as part of your business the ability to make investments yourself in these private companies. Is that what you're saying, or in other kind of other?
So almost all of them were obviously looking for capital. They needed extra capital to go public. They needed extra capital for operations.
Mm-hmm.
And what I saw is the opportunity to have proprietary funds and merchant banking capability under the investment advisory side that could make capital available as basically bridge loans initially for some of these companies.
Got it.
Where once the work was completed and once they were sufficiently capitalized, it would be hopefully low risk capital. There would be a strong return on that investment.
And so did you make a lot of investments like that through your private network, funding it that way, or through?
Well, that product was going to market in 2007.
Okay, so no.
That was going to market in 2007. And so, but even transitioning further, the rest of the model was to then push it even further and start to get back to having trading capabilities, having research capabilities, and trying to bring things together from these kind of pockets of opportunity that I've leaped from point to point through the long gestation of managed.
You're basically trying to get to scale. So
right.
You can take advantage of a lot of some of the synergies across the different divisions, basically.
Right. And really the intent was, you're correct, to get to scale and have a research centric or a data centric institutional financial services firm, and to start build it from that point, from these relationships with these corporate executives that I built up extensively, and attorneys and accountants. You'll see all of that is investment banking work. That's the groundwork for the investment banking role is being built through all of this. Mm-hmm. Right? Those corporate relationships are what they're everything in investment banking. And so I had those in spades. I've been developing them for years and doing close work with CEOs and CFOs, et cetera. So that was the idea, was to cater more to the corporate clients' institutional or financial needs, and to really push the business in that direction. And of course, I didn't get a chance to have that funded as the world fell apart once again, 7 years after it fell apart before.
2008, yep.
And that was the transition back to Merriman, is that we were down, me and my wife had been down in LA for a number of years, in Los Angeles for a number of years with the practice. And she's originally from the Bay Area, and technology was buoying the Bay Area economy again. So we actually made the determination that, it's time to move back to the Bay. And I was really craving that opportunity to still bring all of these core skills back together, but in a very, in a registered, data center securities-based business. And so we did that. And John Merriman is a gentleman that I've known for many years through actually personal associations.
Hmm.
And I knew him as a fighter and a builder and somebody that certainly wouldn't go down without a fight. And his business had been through some transition and some challenges, as many people know, and they're out in the public domain. And he fought through them. And when I sat down with him and caught up, it was very clear that he had a significant side of the business that could benefit from my work. And I was obviously really craving getting back in and having a trade desk available to myself, having distribution capabilities and capital markets capabilities. So it really was a perfect opportunity at that time to start to really bring everything together from the past 15 years or so.
For sure. So you had a chat with him, said, I'm interested in moving back up to SF. You make the jump. What's it like when your first day or your first month? Was it a surprise? Was it weird not running your own shop anymore, or was it refreshing?
Oh, it was totally weird. It was totally weird, but it was extremely refreshing for a while, because obviously you don't have to do any of those things that you had to do, the EDD reports, right?
Yeah.
Right. And all the administrative function was taken off of me. So I could really just focus on work and clients, which I completely adored. And so actually it was
So
very weird.
what was the most of the work that you were doing for Merriman and this is 2012, 2015, correct? That you were there?
So yes, at the time, so again, he'd gone through some regulatory and other challenges that really impacted the business and really shattered big portions of the business.
Yeah.
Through I think 8 or 9 to 2008 or 9, and so he was really in rebuilding mode. So the first thing to do was one. And this is going to shock a lot of people. Since I ran a registered investment advisory for all those years, I actually lost all of my securities licenses. So at least on the stock side, so the 7, the 63, 65, 31, all of those, and 24 had gone by the wayside. Mm-hmm. And so I endeavored on 2 fronts. One was it was all about prospecting. So it was all about prospecting and rebuilding the business and building it into a capital markets business as I envisioned it. With John's full support, which was excellent at the beginning, and obviously getting all of my licenses back. So I spent an enormous amount of time studying at nights and the weekends, and I literally tied myself to a desk and prospected corporate executives of public companies for 8 to 12 hours every single day. There were days, Patrick, where I was back to back on calls for I had 8, 9, 10 calls back to back. It was just insane.
And did you? In terms of capital markets, so what specifically types of did you end up landing any of these clients? Was it more most of the stuff you're doing more around the trading desk and managing those clients that were already in house? Were you expecting successful at all?
It was multivariate. It was actually extremely successful. I was able to successfully recatalyze a significant portion of the business. So we brought a lot of these clients, and most of them were both domestic and international public companies that had been a little bit orphaned by the street, but had had needs for capital, had needs for stronger trading, had senior executives with concentrated positions, and
market caps of what, like 20 million to 100 million type.
Yeah, I'd say 50 to 200.
50 to 200. Okay.
Right. So definitely on the smaller scale, definitely more micro capitalized and small cap companies.
Yeah.
But that was really where the opportunity for rebuilding was.
Sure.
He'd lost a lot of his research functionality, but there was still strong trading there, and I really had what I needed to deliver. And so I focused more on the corporate services initially with these clients, and again, opening getting their 401k open and helping to get some trades, some trades together for them that would benefit their 401k accounts, or handling the 10b5 plans for some of the senior executives, giving them strategy advice, hooking them up with conferences, all sorts of different things. So there was both a consultative side of the service provision, as well as a very strong security side, right? And catalyzing the trading and getting back into offerings and issuances of securities was really the ultimate goal. And so obviously getting involved with them to help them with 10b5 plans, securities plans, and concentrated
what's a
positions.
10b5 plan? Sorry, I wasn't in the securities. It's 10b5. What's that?
Sorry, a 10b5 plan is when senior executive, usually an affiliate or an insider, has a large position in stock and wants to start selling some of that, usually for standard asset allocation. And the best way to do it is to use what's called a 10b5 plan, which is a fully disclosed plan, so that the investment community knows it's coming, can see what parameters are set, and that it doesn't
Creator of the
come
stock,
out and get misconstrued as
right?
the CEO selling. So you put a fully disclosed plan in place, and then all of the stock goes where? It goes across our desk. So it was able to generate revenue on the desk, and really, get our clients back involved with, multiple points of value through the firm. And I proved to be very, very adept at cross-selling all of these different features and functionalities because of my work both as an operator and
Yep.
understanding the workflow of myself, but also working closely with the executives as a consultant for so many years. I kind of knew what they needed and what was on their mind. And I knew, that
So what
we could
changed?
deliver.
What changed after 3 years? So like you're there for 3 years. Sounds like it's going really well. What what prompted kind of the move?
Well, I think
You said that initially that your first place was the easiest transition. Was this one of the hard transitions?
no, this was a fairly easy transition as well, because
Yeah.
obviously I had a bit of a personal friendship and with the CEO, and knew him for many years.
Yeah.
So, and actually he had some great staff there. He really did. At the time, there were just some wonderful people there. So it made it fairly easy. And
Yeah.
of course, I put my head down and busted my butt. So people respect you when you do that. When you come in and you work your butt off and you show results, then they generally respect you.
Yeah.
And so I had the support of my colleagues, and wonderful offices, and it was a really nice transition. But Merriman Capital is no longer around.
Hmm.
So there were obviously some continued challenges at the I guess, systemic or intrinsic to the business, that were never fully overcome.
Do you know what those
Um,
were specifically, or what
financial,
like
financial.
specifically was there just too much overhead for the revenue being generated like through
Um,
obviously, but
that For some reason, Patrick, there was a lack of focus.
okay.
And this is really where, just kind of basic business parameters start to show themselves, that even though it's a broker dealer or an investment bank, it doesn't mean it's somehow immune to standard business practices.
Hmm.
And so, yeah, there was too much overhead, and not enough focus on high margin, or maximizing margins, I should say, around any single source of revenue. And
Right.
then as the financial challenges mounted because of that diffusion of work, and that lack of real margin. um,
Did you feel like you could have helped with that, or do you feel like it was out of your hands? Like,
Absolutely, it was
yeah.
so obvious, but it was out of my hands, and it was obvious to most of us working there.
Why was it out of your hands? Because you weren't the boss at now this time around, or because
Because yes, that was really part of it, and
okay.
there were some peculiarities at the board and the management level with people that weren't really from brokerage,
But
kind of
like he
pulling
was
the
your friend.
strings.
Did you
But
have any like sit down, like stern talks, like
it,
do you really need to change direction here? Why are we investing here? I know there's a lot of revenue, but this is no margin type of
it
talks.
from time to time, but they really didn't seem to have much sticking power or staying power, because and I don't know how much of this is appropriate for disclosure, but
No.
but the truth was, it just there was a lack of focus there, and there were a lot of new ideas that they were trying to put into market, but none of them were properly capitalized.
Yeah.
Most of them didn't fully sync with the standard or the core business, and thus you started spending money on things that weren't furthering the core businesses where you had the bulk of your revenue coming in, and
Got it.
that breaks down. It doesn't matter whether I'm selling HVAC, right? Equipment, or renting trucks, or doing securities.
Yeah.
That is a bad business model. It breaks down.
Well, where
And
would you have
so,
focused? Where was most of the revenue coming in from when you were there, your 3 years there?
well, that's the thing, is the most of the revenue was still coming in through my division and through trading.
Got it.
And so I had, 65, nearly 70 corporate clients. They were all asking for issuances and offerings, but we didn't rebuild a capital markets group or a real distribution desk, which is where the founder actually originally came from as one of the best capital markets guys ever.
Yeah.
And so that was really bizarre. And instead, they were building, platforms for automated distributions that they thought would work and all sorts of things. So it was really strange that they got so far away from the core business model that everyone knew worked and that they still had some real strength, or they could have had strength with, and
Right.
went down all these different paths. And I can only say that, when finances falter at any business, you become really beholden to your investors. And if your investors are not from your business, and your business is highly regulated, and highly defined, and your revenues are highly defined by that regulation, or by those regulatory boundaries, then you can have some conflicts of strategy. And that's really what presented itself. Is I think
At the board
at some
level, it
point
got kind of ugly, and yeah.
it was just kind of going all over the place, and
Yeah.
and I think it was really to try to keep certain people happy, but they didn't really matter. And unfortunately, it just is I think a very common, it's a very common scenario in the middle market firms where, without a core focus and without real domain expertise in one or a couple of things that are centered around our specific functionality within the financial community, you very quickly get off track, and you really have no cushion to sustain yourself through any shocks.
Right. Okay. So things didn't work. So
Well,
long story short, things didn't work out. And so when was it clear that, your job was disappearing, or was it, were you given a long heads up? Did you see the writing on the wall? When did you start looking for your next?
well,
I mean,
obviously we started track. There was a public company, so it was very easy to track the financials. And of course, the inter-office politics was very clear that there were some things that just things weren't getting done. We weren't getting resources anymore for the core business. But I'd really established myself very, very well, and I started to run all of the offerings for the clients because, again, we really didn't have that functionality being rebuilt. So by default, I started doing all the offerings as well. And then compliance pulled me aside and said, "Guess what? You're a banker. Take your test."
take your what?
Take your test.
Yeah.
So I said, "Hallelujah, you are right. When can you sign me up?"
Yeah.
So I was actually ecstatic at that because the more credentials you have, the bigger, the kind of moat you have built around you. So I was happy to do that because I was serving that functionality, and I was starting to do debt and equity offerings on behalf of the clients that I was serving, amongst all of the other functionality. And it was really time to bring it all together in the investment banking role. So I took my Series 79 test, changed my title, and really spearheaded the investment banking portion, which is really what my focus has remained to this day. And so it really didn't matter at that point, Patrick, what was going on with the firm or what direction they wanted to take it. My career was progressing at that point, right? I'd established myself, I had a trajectory, and I was making the best out of it. And so I had, and although I had started looking at other firms and other shops, really this was the time to focus on which firms could really benefit me as a banker to move forward. And so that's why we really progressed from there. And I just kind of resigned myself to allowing, the Merriman Capital to kind of go whichever pathway it wanted to go.
Okay. And so tell me exactly what was it like in terms of like the final meeting, or the that meeting where it was like, okay, this is it, where you resigned, or they said that's it? Was it
It was peculiar. I mean, there was more that I'm really not at liberty to share that
that's fine.
maybe caused some.
I mean, I know when I got fired early on in my private equity career, and I can tell you it came as a complete shock to me. It sounds like you saw the writing on the wall, so it's easier.
Well, there were some very strange peculiarities at that shop, and they're present in a lot of middle market shops, and things that just aren't quite appropriate about how they organize with employees, how they structure compensation. And mine was fairly straightforward and actually extremely attractive compared to what everybody else was being brought in. Because the other problem was, as as the economics eroded, they kind of continued to try to bring people in, but in with parameters that didn't really support a lifestyle. And so there began to be a lot of stress within the organization because people were polarized and, and not really being led in a cohesive fashion, not being supported in a cohesive fashion. And many of us have experienced that ourselves. And it's an unfortunate outgrowth of companies in stress.
How many people were there at the peak, or when you were there? What was the most in terms of employees?
See, when I got there, we were still at about 40 or nearly 50 people. There was still an office in New York and, some New York and San Francisco. And so there was about 50 people, down from about 250. When I left, we probably were down to somewhere between 20 to 30. I can't recall which, but somewhere in there.
All right, fair enough. So you were kind of starting to look around and you wanted to stay in San Francisco area. And so, you have all this experience in semiconductors, research, software, technology. Is that you just looking at kind of smaller firms that specialize in that vertical, or what were the criteria for?
So, there were a couple things. One, I obviously wanted to stay focused on, or at least stay focused on investment banking if I could, but at least be putting that to work, as that was really something that just brought together all of the skills that I developed throughout the years. And quite frankly, and most people will be shocked to hear this, but I absolutely adore the work. As zany and neurotic and dysfunctional as it can be at times, I absolutely love it. I love the energy of it. I love the technicalities of it. I love the compliance regimen. I love every facet of it. It really is. It's really fun. I enjoy it. So I certainly knew that I wanted to continue to progress along those lines, or make that a big part of the portfolio. But I really wanted to make the jump to a big firm.
When you said investment banking, you primarily mean mostly equity offerings and debt offerings, like that side of, because you had already started doing that, right, at Merriman. So you were looking for another place where you could continue developing that or continue executing on those types of deals.
Correct. But more so expanding into the financial advisory role, which actually drew more from my earlier experiences of being close advisors to management.
As a CFO, interim CFO, right? Mm-hmm.
Right. So I'm really looking to scale everything, right? I want a firm of bigger scale so that we'll be seen and hired for those, for financial advisory roles, which I, already was seeing strong demand and good, good rapport with clients in that regard, and doing some of that work, where I could also have more of a formal capital markets desk that could distribute securities, and obviously really, fulfill more of the role in a more well-rounded way. So that requires a bigger firm.
Sure. And so how did you get in touch with the people who ended up bringing you in as an MD?
I actually made, so I started reaching out through my network and had a lot of conversations with firms that felt like I was having a conversation with the firm I was at. And actually, it was really about that time, maybe a little earlier, Patrick, that I realized that the vast majority of the middle market firms are really just shades of gray of each other. Each one has maybe something a little bit better here, a little bit better there, but overall, they're kind of all the same thing. Mm-hmm. And so, I really wanted to make a shift, and I was able to find somebody who really believed in me over at Stifel, a gentleman named Doug Heskey. Mm-hmm. Although Doug was in the asset management side of the business and a really warm and wonderful person, he saw the potential in me to come over to a firm like Stifel and use my skills of cross-selling to significantly enhance the offering at the firm, and also help him with his division extract more value from the high net worth individuals and the corporate clients that they already catered to as asset managers, but didn't really have a way to bring that business out of them, right? Because of regulatory restrictions and just lack of expertise. And so he really went above and beyond the call of duty to help me get oriented with the firm and put me through a series of interviews and interactions, extending all the way back to the corporate offices in New York and in Baltimore.
Is this with Stifel, or this is with another firm he knew?
No, this was with Stifel.
Okay.
To meet all of their all of their senior institutional staff, including their head of capital markets, Thomas Mulroy, who was also president of the firm and president of the international, an absolutely stellar guy, not there anymore, but stellar guy.
Yeah.
And I was absolutely ecstatic. I mean, these guys had huge offices at 1 Montgomery Street, right? It's they had 25 billion in assets under management. This was the real deal.
Mm-hmm.
And even though I wasn't going in as an investment banker, it didn't matter because I knew that all I had to do was get in and develop one thing, right? And then obviously, then I'd have the interaction with the bankers, and they would be able to see my credentials and my experience.
But tell me, what were they bringing you? What were they bringing you in as, if not an investment banker? What, given your?
But he was going to bring me. He was intending to bring me into the asset management division under his in his group.
Got it.
To pair me with he wanted to pair me with one of his most effective and highest producing brokers who had a considerable number of corporate clients, and so that was the connection. And if you know Stifel at all, Stifel is very focused on trying to cross-sell through the bank to increase performance. They have a bank, right? They are a lending institution as well as an investment bank. So it really was just a nice, perfect fit. And I was ecstatic about it.
So tell me, how did it start? How did it evolve?
And so, I went through all this interview process and all this wonderful stuff. And then the interaction got quiet. And, I knew that there was certainly an element of trying to sell this to the higher ups. There really hadn't been a hybrid like that in that sort of function, but things were changing there. So we knew there was some interest. But really what ended up happening is that unfortunately, the individual that they were hoping to pair me with to attack the corporate clientele for them, unfortunately had been doing some things that perhaps he shouldn't have, and he was let go, and that really, that kind of set things a bit adrift.
Right. So they weren't sure what to do with you because they needed him for you to be effective.
Exactly. Well, it wasn't just that. It was actually something of a regulatory nature, so it really impacted the prestige of the group, and unfortunately, my sponsor, if you will, and was also relieved of his situation.
Wow. So this is a pretty dramatic. You're ecstatic thinking you're going to be joining this great outfit, and
I'm waiting for my offer.
You're waiting for your offer, halfway out the door at Merriman, if you're not already at the door. And I assume you own a home at this point in San Francisco, or you're renting, and you're thinking to yourself, this is it, I'm going to be able to stay in SF, or you're thinking I'm going to move to New York. What was the plan?
Well, I just thought, man, this is going to be fantastic. This is the ticket. This is what I've worked for, and this is what I've struggled for, and this is what I put myself through all those years of pain and pay and things like that for. So yeah, I was really looking forward to it. So
when it went quiet, what did you do?
Well, I continued my efforts in the background with other people, and so there were some other irons in the fire, and those continued to progress. And I unfortunately, once a firm starts to really slide down a certain path and slide downward, I like to put it this way, Patrick, and this happens for every business. Whenever a company has to save itself from some financial pending doom, right? You have to do what? You have to give something up, right? You have to give up a little bit of the ownership. You have to give up a little bit of your soul to make it work.
Yeah.
So you basically start, you start walking down the staircase. And unfortunately, in Merriman's case, they had continuously stepped down a number of times and done some capital raises, and it just was continuing down that path. And so obviously we have certain capital requirements in brokerage and investment banking. So I knew that it was unsustainable. So it wasn't like I could just go back forever. A transition was coming for all of us, whether we liked it or not. So I had to continue my pursuit. And so that's really, and that's when, I got close to the Benchmark company.
And so tell me about you. So you were there for around 3 years. Is that right?
Yeah, I was there for a little over 3 years, and
2015, 15 to 18, just for the context. So yeah, okay.
Yeah. Yep. And what Benchmark had, or what represented at that time, was, yeah, they were another middle market firm, but they were really focused on banking, and they just brought in a head of banking that had led one of the top middle market banking shops for many years as its CEO. So he was more of an administrative guy, not just like a big talker.
Mm-hmm.
And so I was impressed with that. And they had a capital markets desk, a dedicated capital markets desk. But more than that, and for people that know investment banking, they know this is valuable. They have some extraordinary analysts for whatever reasons, and particularly technology analysts. And so even though Stiefel had been, my hopes there had been dashed because of that issue that had arisen in that group. This looked like a really a positive step forward as well, because I would at least get those components that I felt was lacking from the practice at Merriman, and be able to really focus as a managing director of investment banking on that expansive banking opportunity. So
okay. So tell me a little bit about like your day to day there. So when you first arrived, what were the resources given to you? How were you expected to build your business? Was it like just start calling on any corporate clients you have, or were they like, hey, here are the people who've done offerings with us in the past, see if they want to do a secondary, see if they need more debt? Like, was there any sort of guidance, or they expect you as an MD to just bring in your own business and you're going to cut of that?
It was, unfortunately, as is the case with most middle market firms, it was the latter. Yeah. I mean, it was like my first day
it's like, here's your computer, or just here's your desk.
Not even. Oh my God. At first I had to bring my own computer. It took them 6 weeks to get a computer together for me. My Lord, it was unbelievable. It's like I joined a rickshaw.
Yeah.
But, it was really all up to us. It was really all up to me. And
what were you given? Any analysts, any associates, anything, any support?
No, I was given nothing.
Okay.
I was given nothing. And I knew that going in, but there was some time pressure to get out of Merriman, as I
of course, I understand why you had to move. But can you tell me a little bit about, like, knowing that they know you're at Merriman? Probably everyone knows Merriman's struggling. So did it hurt you in negotiations in terms of, was there any negotiations in terms of, like, you're coming in at an MD level, right? And you say, my guess is pay there is largely, there'll be some sort of base, but it's pretty small. And then there's a huge upside component if you're bringing in a lot of business or doing a lot of offerings. Is that accurate?
Yeah, that is. So it's a firm like Benchmark.
You mind, like, giving me some ranges so that the listeners can understand what it means to kind of be at a senior position at one of these middle market firms?
So unfortunately, there is a layer of the middle market, of which Benchmark is part of, that really has no set compensation, and the vast majority of it is variable comp. Yeah. And the vast majority of the firms in that category are like that, or quickly trying to move towards that.
And so tell me a little bit about what that upside can potentially look like in a good year, or how somebody would think about going to negotiate if they're going to go try to do this and be kind of eat what they kill.
So sure, your negotiations center around things like your office situation, your benefits, and healthcare costs, and of course the percentage of the fees that you're due to receive on your transaction.
Right. So like, in terms of ranges, are we talking like, let's say you bring in $1 million in fees for the firm? Are we talking in 1 year? Are we saying that they'd pay you like 30% of that plus your healthcare, plus your, give you your office? Or are we saying, like, is it more like 60-70% they pay you? And so they
present to you 50%, essentially. That is the approximate.
Pretty
that
standard.
Is the approximate range.
So around 50% of the fees you're bringing in are yours, but they're giving you a platform, the name, the analysts,
right.
The research analysts to give you that.
And because I was coming from a salary plus bonus role at Merriman, and we had good benefits there as well. I was really able to focus the negotiations on making sure that those more intangible items, or I'd say
were taken care of.
The peripheral items were negotiated in a very, very attractive fashion. But yeah, it was a real big challenge.
And so were you nervous about it going to pure pure commission versus salary and
It
bonus, or did you feel confident enough that you'd been doing this long enough that you knew, hey, I'm going to close enough to do well?
See, if I'm talking to you, it's one answer. If I'm talking to my wife, it's a totally different answer.
So tell me both.
A little of both. Obviously, it was not what I wanted. It was not optimal. And it's not what I was looking for. And I knew that it was going to affect my approach to the market. It was going to affect what types of clients I approached, and what my
Why?
daily workflow was.
Why do you say that?
Um, you don't have time to dig in and focus on the strongest opportunities or ones that you really believe in. So you really do have to focus more on things that you think are immediately actionable. Basically, clients that you see some sort of stress,
Got it.
right? And that gives you white face as a small provider, but you also know that management is motivated to get something done if you can bring value. But those are typically not durable businesses, and they're not necessarily great for the long term. But
But when you're on
getting back to
commission, you need to get the offerings and bring in fees.
Exactly. And no matter what, no matter what, investment banking, and the reason it is not optimal and not appropriate to compensate anyone like this is because of that. You end up putting people in a position where they have to go after business which is non-durable and not necessarily optimal and not necessarily of any interest to the vast majority of investors. And so that doesn't help you build your business. But also it means you really can't, you haven't aligned compensation with objectives. Right, and that's objectives with the individual or the firm.
So tell me,
kind of helter skelter.
And when you were arranging these offerings, tell me what exactly. It's for the listener. Tell me exactly what that even means. So, like, just give me an example. So, like, let's say we have a private debt offering. So, let's say Can you give me an example of one you did when you were there, where you found this company, or how you even found it, how you screened for these companies, how you even got in touch with them, or is it all just your Rolodex? You're just immediately start calling people you know.
That's a little harder. I mean, I really have to say I'm extremely prolific. I'm really quite good at it. So
okay. You're really quite good at. Sorry, you're really quite good at what?
I'm really quite good at prospecting and development. And so.
So you don't want to share your secret sauce, or you're saying that what's hard about it? I guess. I mean, what are you using? What are the tools you're using? Let's start there.
So I guess, a lot of this still goes back to, everything that I had done for decades before was really, yes, I would do screening, right? I would tap my network aggressively, and still do to this day, and obviously reach out to everybody that I knew. And I use email very effectively, and I use the phone very effectively to call my contacts and let them know what we're doing to get referral business and to find opportunity. But I do absolutely do a screening in my role, and I'll screen through S&P Cap IQ, FactSet, what have you, for companies that are in the space that I want to focus on, and that seem to have some sort of financial stress where I think I can uncover a solution or help them make some incremental gains.
And then how are you even making it through? How are you even getting past the gatekeepers to talk to?
Oh, that's easy. That's easy when you're me.
How is that? Why? Why is it easy if it's you? And what makes you able to do that?
I was the CEO for many years, and even though the size of the firm wasn't such that people would think that I'm Jamie Dimon or anything like that, the truth is it really is a differentiated viewpoint. And I really got accustomed to working with CEOs and CFOs in a very fluid fashion. They don't scare me, which bankers, I'll tell you, are terrified of their clients. It's hilarious. It's really funny. I mean, they're terrified. I am not. There is always another client around the next door. Clients come, clients go. I don't care. I usually have 4 or 5 transactions going at any given time, whereas your average banker does maybe 1 or 2 a year, if they're lucky, and they sit around and wait for it. I'm very proactive. I attack my market. And because of the passion that I have for the business, that's what drives me. So I want to go out there every day and find a new solution or a new opportunity.
But how do you get around? But like, for the people that are cold, how do you get around this? So yeah, I get it. You have a pretty good.
I'm very respectful of them and their time. Okay, it's that simple. So I'll do something like, I'm very adept at getting contact information, and I'll just reach out to. Now, the other thing is I know who I work for. Most bankers, and going up to all the bulge bracket, most bankers don't know who they work for. Everybody thinks they work for the CEO. You do not work for the CEO. That's the ego. That's the ego. The investment banker and all investment bankers, the relationship is maintained and managed, and all output function is controlled by the CFO. And I was what? A CFO for hire.
Mm-hmm.
So that I've always leveraged that, and that has become very, very important to me, is that common experience of going through the PCAOB audit, for example, of answering open items, of drafting my management discussions and analysis. That's where we connect. We've done the same thing, and
so
that has really buoyed my opportunity.
A lot of these are just cold emails. You're blasting out 50 cold emails a day, LinkedIn messages, what have you, anything you can to try and.
I actually try to be a little bit more
thoughtful,
narrow than that. So I don't use LinkedIn or anything like that.
Yeah.
I have, obviously, just to get a basic connection from time to time, but no, I try to send a personal email, and it's usually something very simple. May I have a couple minutes to learn about your business? And that's truthfully what I'm after. The first thing I got to do is I've got to find out what you need and who you are, and I've got to, have a conversation. And with the CFOs, and once they realize that I have that operational background and some common experience, they're usually very accepting of that, and they're usually very welcoming. And if you kind of give them the floor and, and just ask for a basic, hey, can you tell me about your business? They're usually very open to it. And so that's really how I started. But I just usually have kind of a knack for it, and I can respect their workflow. I know what's on their mind generally, and it's very easy for me to talk to them because I've been through some of the same rigors.
Fair. Okay. So, tell me what happened. So what's next? So you were there. It sounds like you did really well.
It was very challenging at first, but that's where my focus on semiconductors and technology hardware and IT hardware really started to emerge. We had two of the best analysts in the industry for these two spaces. One, a gentleman named Gary Mobley. Gary Mobley is known for specific coverage in semiconductor space, which is very rare. He's now at Wells Fargo as one of their senior analysts. And our other analyst, Mark Miller, had a Nobel Prize in physics for his work at NASA in the 80s, and some very highly respected individuals. And it just so happened that my transactional success started to emerge in their universes. And both of these guys covered some of the more prestigious and prominent companies in that space. So I saw that as my opportunity, for example, Patrick, as to back to Stiefel, right? I knew that the future lied in the bigger companies. And I knew that, following my analysts religiously and using that open door to develop those relationships with the larger companies in the $1 billion and more market cap category was where the durable future lied. And so really that's where I focused. So although it was once again very, very difficult to get into business, and very rocky for the first, say, year and a half, once I was able to develop some of those transactions and close some transactions, and once I'd made enough and spent enough time with these executives, then it started to, then it really started to emerge and unfold from there.
That's great. And so tell me kind of what you've been up to in the last few years.
Well, last few years. So after I left, I was still really focused on making the same sort of shift back to a very large firm. And various opportunities developed. It's a very, very long road. And what's very interesting and unique about kind of the managing director of investment banking role at a large firm is that they come for you. You can't go after the job. They eventually, reach out to executives that are in their coverage universes, and that's how the referrals start. So you kind of have to just keep putting your feelers out there. You've got to maintain your work with your clients and maintain your visibility with them. And, ultimately, eventually somebody's looking and they come and ask for an interview or for an introduction.
Great. And
And so that happened with another middle market firm that was looking and lost their long time San Francisco based managing director. And unfortunately, it was once again a firm that I really had excluded from my list because they didn't have physical footprint in San Francisco, which I believe is a strong success factor. If you're going to be competitive in your market, you have to be present in your market. And so I saw some challenges ahead, but I was really anxious to get back in the workforce, and that's where I decided to go back and help Craig Callum Capital Group out, and they also had some really excellent analysts, and their coverage really overlaid very beautifully with my coverage universe. So I spent some time working with them, and I think doubled their coverage in this space within about 7 weeks. But it was like I mentioned earlier, it was a lot of the same.
So you're now doing your own thing.
And so that's correct. And so I realized, listen, it's
time.
It's just
it's time you're CEO again.
Exactly. And I really wanted to have that focus emerge, and or I really wanted to remain focused on that. And I saw all of the opportunities to create something that delivered what the clients were actually demanding, because during this evolution, Patrick, I really started to see that the clients across the board were really gravitating towards that CFO and operational background. They saw it as being, extremely valuable in the overall strategic development and the strategy calls and strategic work that we were doing. And I was starting to get calls from clients who were, and this started at the end of Benchmark, who were asking to hire me as confidential financial advisors to oversee the work of other large firms. So ironic. Credit Suisse doesn't want to talk to me. However, what they don't know is I've been supervising their offerings, and the questions that some management teams have been asking of their bankers were written by this guy.
Yeah.
Very interesting, huh?
Yeah.
So, I'll never forget that particular engagement. It was a Sunday morning, 7:30. I get a call from a CFO who I've been courting for years. Longtime Cowen client, and everybody else, covered by everybody on the street. And I pick up the phone, of course, because that's also my background. I'm never off. I still have that mentality. I'm never off. So, and if he's calling me at 7:30 on a Sunday, there's something up.
Yeah.
So I pick up the phone. He says, "Look, we've got this thing. We desperately need to recapitalize some of our credit situation. We're getting a lot of offers from different places. You've always struck me." And he said this, I'll never forget. He said, "You've always struck me as someone who would tell me the truth." I said, "Absolutely." He said, "So what I'd like to do is I'd like to bring you in as our, confidential advisor, working with me and the board to analyze and assess all of these different options and make, clear recommendations to us." And I said, "Absolutely, no problem. Let me get an engagement agreement together." He said, "Sure, send it over to me." And as soon as I did, he called me right back and he said, "Look, man, this is great." He said, "This is great, but I don't know that I was really clear. I was really hoping to just hire you. Is there any way I can hire you and not Benchmark?" And that's when I went, "It's time."
Yeah.
And I said no. And of course that flowed through the firm as it's supposed to. It was very successful. That firm at that company at the time was trading at 98 cents. The work that we did together then unlocked significant value. The company today, this is only a year and a half later, trades at $37 and nearly $4 billion in market cap.
Wow.
So, very successful. That was a very successful engagement, and really represented what I saw as kind of a coming back together of, okay, my clients really do respect me in that role and rely on me in that role. And I think I am prepared to lead the way again. Great. Or try to.
It's exciting. It's exciting. So, you've set up shop. It's called Semi-Cap Equity Partners is the name of your firm.
Correct.
And, so I'm sure a lot of the listeners, if they want to be in San Francisco or they want maybe an internship, maybe at some point, or you'll need some analysts at some point, you know where to look.
I would absolutely welcome it. Another part of this, Patrick, is that, I'm really frustrated by or I was very frustrated by the volatility and the variability of these firms because of what is essentially poor management. I'm sorry, if you don't have a focus, if you don't lead your members, if you're the head of banking or maybe the founder and it's your initials on every single banking deal that's currently active in the space, you're not providing leadership. There is no proper leadership. There is no proper financial structure to these organizations. Compensation is an absolute disaster.
Mm.
And these are very simple things to correct.
Yeah.
So a very big portion of what Semicap Equity Partners is all about is trying to create a business and build a business that is specifically catered to the needs and the demand of the clients, while then also organizing it in the most practical, logical, efficient, and appropriate and professionally appropriate ways. Mm-hmm. And that means proper compensation for people. That means a focus, a business that's known for something, which is why I chose the admittedly somewhat kooky name. I don't want healthcare. Don't bring me healthcare.
Semicap, yep, Semicap. You're very clear what you guys are specialized in.
Exactly.
Yeah.
So we can be known for something. We can deliver real value to clients and real mind share value. Mm-hmm. Right? They know we know something. This is all we do. It's all we focus on.
Yeah.
You know, I don't care about microfiltration bubbles anymore. That's enough. Right. So that's a really key thing. And that is where margin comes from. And ultimately, yes, although we're starting with a small team and a small group, we have very large aspirations, and the goal and the objective is to have all of those key institutional functions present, including research and trading, of course, because, and again, where a lot of these firms just simply don't put it together is that they're all part of the same margin pool, right? And by not having focus and by being diffuse, that's why they always suffer financially.
So right? What's your focus first? What's your focus first in terms of what are you setting up? What's kind of the initial thing? Is it more just, you're going to be more kind of like a one-off kind of consultants, kind of the CFO role, or do you see yourself kind of quickly trying to build up and scale your team?
We're on the latter. We're very aggressively trying to scale the team. We already have engagements both on the financial advisory, for M&A style work, as well as on the capital markets and distribution side. We're currently embroiled in a couple of distributions, so the sooner that I can grow the business and grow the talent pool, the more opportunity that we can process, and the quicker we can process it. And that's the other fundamental piece here in services, and this is something that's missed, and maybe I said it earlier, I'm not sure. In services, people are your product. People are your inventory. Most people don't understand that. And just like if I manufacture a product and have to start my supply chain and put my money into, building the product in the inventory before I can go to Amazon or to Neiman Marcus and sell it, right? It's the same thing with people. In services, that's why the credentials matter. That's why your experience matters. And so, I'm here to bring together the experiences and the credentials that are relevant to my clients. Our first VP has both a CPA and a CFA, because accountancy is everything that we do. It's the core underpinning of the public company CFO's world, right? So if I have that on staff, I can give better counsel to them. I can give better product. So I'm very, very committed to people. I'm very, very committed to clients in that way. And I really do recognize that it's the people that we're selling. It's their abilities and skill. So the more great people I can have compensated properly in a functional, cohesive package where everybody's working on the same thing. My traders are trading the right names. My analysts are analyzing the right names, and my bankers have the relationships with all the same names. Then we are providing a cohesive package and a comprehensive package, and thereby, hopefully, seeing the results in the margin profile of the firm being significantly greater than most. And so that's really what we're building, and all around that core focus on semis, IT, and IT hardware.
It's exciting. It's exciting. I think I'll definitely be watching and seeing what happens.
Well, actually, with your help, this is being associated with Wall Street Oasis is brilliant, right? I love what you've built. You've built one of the largest communities. I think it provides education, it provides access, and so those are things that I gravitate towards, and I feel are part of our makeup as well. So actually, I'm elated to be here. I thank you for putting me on the platform, and I hope that I can do some great work for you and for your candidates and for your community members as well.
Great. Thanks so much, Douglas. I appreciate you sharing all your stories and with the community, and let's stay in touch.
My pleasure, Patrick. Thank you very much, and I look forward to speaking with you again soon.
And thanks to you, my listeners at Wall Street Oasis. If you have any suggestions whatsoever, please don't hesitate to send them my way, patrick@wallstreetoasis.com. Until next time.